Thank you for joining us today. My name is Michael Lewellen. I'm the Director of Financial Planning at OJM Group. And today we're going to be discussing a cash alternative strategy with the goal of improving returns on your cash while maintaining liquidity. If you've been disappointed with the interest rate that you've been getting on your cash, this is a discussion that you might find helpful. What we're going to take a look at today is just historically what everyone else has normally done with their cash, how they've invested it. You'll probably be familiar with it, what the current rates are on those types of accounts as of this recording. Then we're going to take a look at the cash alternative strategy and specifically an analysis or an example so you're able to see the actual numbers. And then we'll go over what else you need to know, including taxation. So what are you currently doing with your cash, or what are your options? Well, most people have them in money markets, savings account, checkings account. If you wanted to really try to change things up, you might have a CD or a certificate of deposit at your bank. If you look at what you're currently earning or able to earn on those accounts currently, you can see that it really on the savings account tops out at about 0.5% right now. So not a lot of return for your cash that you may need to be holding. Same thing in your checking account as well too. On the lower end, in some cases, depending upon the institution, maybe you're able to get up to that 0.5%. If you really want to try to increase your returns and lock your money up for 2 to 5 years, you can get up to a little over 1% rate of return with CDs currently. That obviously, in a lot of situations for cash, doesn't make sense for people. And you're not being rewarded much, really hardly anything at all on your cash currently, just with the current market. So let's look at a cash alternative strategy. And I think it's important to know that we're talking about cash that isn't your emergency fund, isn't what you're using to spend every day. These are for dollars that you really know that you're going to be saving for an extended period of time, maybe 6 plus to 12 months, that type of thing. What we use for our cash alternative strategy is a universal life contract, so a life insurance policy. Now, this policy has 100% liquidity. It has principal protection, and it is different probably than most you've heard of in the past. It's what we would call a modified endowment contract. Now, what that means is that everything is going to grow. Your growth is going to grow tax deferred, but it's going to be tax regular income. So just like your savings account currently, and we'll talk more about taxation shortly. Where it really starts to differ is there's a 2.5% guaranteed fixed rate there. Now, with the insurance contract, there's expenses inside of there, so that effective rate on the guaranteed portion really ends up being about 1.25%. The real advantage is you're able to take all of that cash and allocate it to index options, meaning not the S&P 500 where it can go up, 40% and down. What these are with these index options, there's a floor of 0%, and then there's going to be a cap on the upside in the 9 to 8% range. Now, there are some index options that actually don't have a cap, so that's something that we can talk about if you want to see a specific example as well too. Let's take a look at an example. So this is a 43-year-old that needed to keep about $1 million in cash. And if you look at the first column, the high yield saving account, they're earning that 0.5%, you can see there. Now, the 2.5 fixed interest option, again, that's kind of the floor. So if you were to not earn anything and when you allocate it to the index, this is the minimum account value, if you want to think about it like that. And you can see even in year one that it is more than double the cash or the cash inside of the savings account. Now, where you're really able to increase your returns is if you allocate to the index options. So you can see there, what we're using is an illustrated rate of 6.31, and that's been a 10-year average of the index option. We're actually using an index option here that doesn't have a cap. It is a little bit more conservative. But you can see the tax-deferred IRR starts at 5% and then really stays in the high 4s, 4.9 for that 10-year period of time. Now, in both cases, you also have a death benefit, and that's just really an added bonus. Obviously, you're not doing this primarily for the death benefit, but it is there. And if something were to happen to you, then that death benefit would be paid to your beneficiaries tax-free. Let's look at another example of a 60-year-old. We like to show that it works in different situations, obviously. So same thing, if you look at that first column, the high yield saving account versus the 2.5 fixed interest, about double there in that situation of growth. And so what I'm looking at is the 500,000, you've got about 2,500 of growth versus that 5,600 of growth in the fixed. If you look over again at the index option, you've got growth of over 24,000 there, and your IRR again is in that 4.9 range and stays in the high fours. And then if you were to have it for 10 years, get down to about 4.5%. You also have a death benefit with this one as well too. You can see it's lower, and age plays a role in that aspect of it. How is this taxed? So this strategy is actually taxed the same as your savings account. There are a little bit of differences. We'll get into that. But everything is going to grow tax deferred, where it's a little different than your savings account. They send you a 1099 from your bank every year. Inside the insurance contract, it's actually tax deferred until you take those dollars out. So that's one difference there from that standpoint. There's some tax deferral. Now, if you're under 59 and a half, there would be a 10% penalty on any of the growth, not on anything that you put in, just on any of the growth. So if we go back and we look at our first example of the 43-year-old in this situation, you can see the cash value in year one, their growth is about $12,417. Even if you reduce that by that 10% penalty, you can see obviously you're still going to be almost double what you're earning in the high yield. Same thing if you look over at the cash value. Obviously, if you were to earn that 6.31 cap from the market, then it's going to be reduced by about $5,000. So you're going to be in that $45,000 range, which obviously, compared to the $5,000 in year one is significantly more. So even with the penalty that you would have to pay if you were under 59 and a half, the guarantee keeps you ahead. And then obviously, if you were to have market performance, then it would be even better. We mentioned again that it's tax deferred, but also that death benefit that you would receive is tax-free. And again, I think if you're trying to look for a strategy to earn better returns on your cash, this is definitely something to consider. So if you just like keeping a lot of cash, some clients of ours like to do that. If you have a business where they require you to keep a certain amount of cash, this is certainly an opportunity where you can earn a better return or yield on that cash. Again, you're able to maintain complete liquidity. So if you need the cash, you can get it. It's not tied up like it would be in a CD or other strategies that may tie things up. You can change the strategy. So meaning if interest rates were to go up and it becomes, just makes less sense from your standpoint, then you can take that cash out and put it back in your bank without any downside there. Obviously, some of the guarantees are helping offset that. And you have the ability to allocate to the index 100%. And that's really where the difference is. There's no real downside in not allocating to those index options. So if you implemented this strategy, you would want to do that. And the 2.5% guarantee rate, again, ends up being about 1.25, but that helps outperform even from a worst case scenario versus what you're earning right now in your checking account or in your saving accounts. So if you would like to discuss how to improve the returns on your cash, we would love to have a discussion with you and see if we can be a resource. We can put together an analysis just like we did in the example and go over it with you. And we would welcome the opportunity to be a resource. Thanks.